Hi, welcome to this video where we're going to look at sales budgets. Follows on really from cash budgets. So we need to think first of all about what a sales budget is, and then we'll do a quick example. The example is linked to more so an Excel style question on sales budgets, although again the basic theory is applicable to all the exam boards that I've taught A-level accounting for. And then there'll be a question for you to do, and we'll look at some of the benefits of budgeting to a business. Sales budgets, probably the most important budget in some ways, because if we don't know the sales, we can't plan purchases, we can't plan production, we've got no idea what the main receipts of the business are going to be. So it's a very important budget, drives all the other budgets. It works in terms of either units or the value of the goods sold, and quite often you'll be required in an exam question to both do the budget for the number of units that are going to be sold, and from there generate the information on the revenue or the receipts the firm are expecting. They're also the most difficult budget to get right, partly because it's very much a guess as to what customers will buy. And quite often salespeople are very optimistic people, so quite often they will overplay the amount of sales they're expecting to get. You don't know what the competition are going to do with their own price, or whether they're going to release, for example, a new product which is going to be more popular than the firm's product. Nobody knows at the start of any financial year for certain what is going to happen with the economy. I'm making this video in 2020, and firms' predictions about the economy in January would have been clearly wrong in just about every country in the world, because nobody was expecting the coronavirus pandemic and things like government policies, what governments are going to do with income tax, corporation tax, government spending. Nobody has an absolute firm idea about what they are going to be, and all those will feed into the amount of goods that customers are going to purchase. Normally, when we're doing a sales budget, it will be done using a mixture of information from various sources. Obviously, past performance will be important. If we've not sold any products this year, it's unlikely we're going to sell 1 million products next year. It also needs to account for seasonal variations. So, for example, there are businesses in the UK which grow and then sell Christmas trees. They would not produce a sales budget, anticipating any sales in January, February, March, April, May, June, July, August, or September, or even October. They may start to make some sales in November and December. So seasonality can be very important. You need to be looking at what the competition is currently doing. Are they improving their products? Are their products becoming more popular than ours, or vice versa? You need to have a best guess about the state of the economy and trading conditions. And you need to listen to both market research and the people actually selling the products, what they are saying about demand from the customer. You can see it in a number of formats. So this first format here looks at a sales budget where we've been asked to do it in terms of both units and currency. So obviously here they are selling each unit for $2. If they're predicting sales of 2,500 units in month 3, that equates to receipts of $5,000. And you will sometimes be asked to do it in terms of individual products. So here we've got product A and product B, and the sales of product A are expected to be $6,000 in month 1, $5,000 in month 2, $7,000 in month 3. Okay, I'll work through a quick sort of sample type question. This question is very similar to the questions that they have in quite often in Edexcel. They're broadly similar for other exam boards as well, for example, AQA. So you'll get the information on the sales. In this case, we're only given the information on the unit sales expected for Alpha, Beta, and Delta in January. You've got the selling prices in January and some additional information down here. Okay, so the first month is very, very easy. So you should get the marks for this regardless of whether you've read the question properly. And we're just going to take the number of units times by the selling price for January for all three products. So for example, for the Beta, we expect to sell 3,000 units. Selling price is $4. So the total value of the sales in January we expect to be $12,000, and you would just do that for each product. And then a little bit trickier, but it's really like a word question you would have done in maths during your GCSEs. The sales of the Alpha are expected to increase by 10% per month, but nothing is going to happen to the selling price. So for month 2, 2,000 units times by 110% times by 2. So 2,200 times 2 gives a expected sales of $4,400. And again, you would increase the 2,200 by 10% in March, and that would give you expected sales of $4,840. Sales of Beta are only expected to increase in March, but they're expected to increase by 50%. So February, you're not expecting any change. It's still 3,000 units times $4. But then when we get on to March, we just need to increase the number of units sold by 50% and multiply that by 4. So it gives us anticipated sales in March with a value of $18,000. And then the selling price of the Beta is expected to increase by 20% from $5 in February. So 20% of 5 is 1. So the new selling price will be $6. So 1,000 times 6 gives us $6,000 of sales, and that will stay the same in March. Okay, so when the question doesn't say there's a change in the month, you would assume that it continues to be the same as in the previous month. Okay, pretty straightforward. There's there's one question there for my students to do before they watch the end of the video, and then there's a short section just on the benefits of budgets. Okay, benefits of budgets. How does the business benefit from doing it? Well, first of all, obviously forces managers to think about the future and to formulate realistic goals for a business. It will show you strategies and policies that may fail to deliver. So if you have a production strategy and there's clearly a mismatch with the sales budget, when we look then at the production budget, then we know that we need to change something quick within the business. It enforces consistency or goals within a business because businesses or the budgets are interlinked. So, for example, for the sales department to meet their sales budget, it also needs the production department to manufacture the products so that they can be sold. So it gives the whole firm a focus. What the purchasing department is trying to do within their budget should be linked to what the production departments are trying to do within their budget, and therefore that should be linked with what the salespeople are trying to do within their budget. It allows effective performance management. So what we can do is we can prepare the performance of managers at the end of the year with the actual performance that was predicted or hoped for within the budget. And for my students, you may have already done standard costing and variance analysis, and that links into the budgeting process. And hopefully, if the budgets are done correctly, so they are smart budgets, which are specific, measurable, achievable, realistic, and timed. They can be very motivational and also a way of communicating and explaining to everybody within a business how their little bit helps the firm to meet its overall objectives. Right, thank you very much for listening. Have a great day, and see you again hopefully next time you listen to one of my videos.